Hi, I'm Scott Sterrett with Sterrett Wealth Management, a part of Canaccord Genuity Wealth Management. So today, when we look back at the month of May, we really have seen that there hasn't been much of a change in the overall markets for the last 3 months. If we go back looking at March until the end of May, there really hasn't been a lot of change in the overall indices. Now, there's a lot of stuff going on behind the scenes. For example, and I spoke about this last month, the difference between growth stocks and value stocks, and the idea that growth stocks have been not doing as well really over the last little bit compared to value stocks. And so, but really there's not a lot of excitement in the markets right now. For the most part, it's what I would call treading water. That doesn't mean that there can't be some volatility, as we've seen day by day or even index by index. Lots of days, the NASDAQ index, which is predominantly a tech company index, has been way down, where the Dow Jones, which is more of a blue chip cyclical kind of index, has been way up. And so days like that, and the opposite's true as well. So days like that will happen from time to time, but for the most part, the effect has been pretty neutral over the last few months. So I thought today what I would do is answer some questions that people have been asking in some of our reviews or in some of the emails that have been coming in. And one of the biggest emails that we receive is what's going on with the portfolios if we do get inflation. And I'll talk about inflation in a minute, but I want to speak about the portfolios first. So with the portfolios as we have them set up right now, anything in that yield bucket, so these would be traditionally things like bonds and loans and debt of some sort, credit of some sort, they all have protected or are benefiting from an increase in interest rates. And what I mean by that is some of the funds that we have will actually increase their interest rates as the interest rates go up in the market. So they're floating interest rates, just like a variable rate mortgage, for example. And so us as an investor, we end up getting paid more money as the interest rates go up. In other cases, some of the managers have protected against interest rate increases by hedging that part of their portfolio. So they may not get the benefit when interest rates are going down, but they aren't getting hurt when interest rates are going up. And so that's been a big focus of ours, is to kind of take care or eliminate any of that interest rate risk in the portfolios. The defense side of the portfolios are operating as they should. Because they remove a lot of the market activities, you really shouldn't have a lot of change as it applies to inflation. They should continue to generate their returns through the ways that they've been generating them for 10 or 15 years. There shouldn't be really any big changes there. And when it comes to equities or stocks or in the market bucket, that's where you could see some temporary dislocation in the market if we do see inflation go up. And it's less about whether inflation's going up and more whether interest rates are planning or to go up with it. And so I would say that on the equity side, we have been, and I continue to say this, I know every month, but we continue to be underexposed to equities as a percentage. And the one form of equity that traditionally has done well when inflation has picked up has been the commodities, or anything priced in US dollars. So that would be things like gold, which we have exposure to. It would be things like energy and mining, which we have less exposure to outright, but a lot of the managers are starting to take little bits and positions in each of these. So we really see a portfolio that shouldn't be that affected by inflation. That being said, because we are defensive, we have put money on the sidelines in anticipation for some volatility that we can take advantage of. So the goal here is to try to get the best of both worlds, to prevent any big downturns due to inflation or any other market activities, but still have money sitting on the sidelines so that if we do see this downturn, we can get that money to work very, very fast. So that's as far as the portfolios go. When it applies to inflation, one of the biggest issues around inflation is whether it's a permanent type of inflation or transitory. And the best example of a transitory type of inflation would be used cars. So we know that the price of used cars has gone up significantly over the last 18 months. And that in itself is inflationary. And so when we look at that, we say, well, is that permanent or is it temporary or transitory? In this case, we think it's temporary because the reason, or one of the biggest reasons why used cars are going up, is because there's a shortage of new cars. Why is there a shortage of new cars? Because there's a shortage of microchips. And so you see my point here is that some of these issues will end up getting solved. Now, it could take a period of time before the microchip situation gets solved, but once it does get solved, theoretically, you should start to see more new cars coming to the market and more people buying new cars instead of used cars, which means the pricing pressure off the used cars will drop down. So the big question that the market and commentators, and you're going to hear it all over the news, is inflation and whether this is short-term or long-term inflation. And the flip side to that, used cars being the transitory part, but the permanent part is you are seeing some pricing pressures. You are seeing companies having to pay more and more money. There was one article that was on Fox News the other night where they interviewed a restaurant owner who said that right now they're paying their dishwashers about $15 an hour. In order for them to get someone in the US to give up their unemployment benefits in order to come back to work, they would have to pay in the neighborhood of $22 an hour for that dishwasher to be better off by working, financially anyway. And so you have to sit back and you say, okay, well, that's a lot of money to pay, $22 an hour. And you know that when things get back to normal, when the unemployment benefits finish up, when people start really getting back to work and there's no incentive for them to sit back and collect unemployment benefits, then at that point, it's very difficult for you to drop the person's wage from $22 an hour to $15 an hour. And so that in itself is one of people's concerns is that permanent inflation? And wage inflation is probably one of the most permanent types of inflation because it means that it's very difficult, obviously, to reduce someone's wage. People are used to having increases. Very few people are used to seeing decreases in wages. So that inflation argument is going to, I think, be with us for the coming months, especially as we continue to compare the inflation that happened in, say, for example, April, May, or June with the prices that were in place last April, May, June when we were in the middle of a pandemic. So the reason that inflation, to go back to basics, the reason that inflation is more of an issue is because inflation means that there has to be an increase, or usually means that there has to be an increase in interest rates. One of the biggest ways that you reduce the inflation that's being seen in the economy is increase interest rates to slow down the economy. So at what point does the Federal Reserve, Bank of Canada, European Central Bank, at what point do they increase interest rates? Or the first step actually being to decrease the amount of money that they're printing. And that leads me to the second question that we get a lot of is, so there's this feeling that there's inflation out there, but the 10-year US Treasury, the benchmark bond, has really not moved that much in the last couple of months. So how can there be this inflation that's been rumored to happen, yet the interest rates aren't going up? And probably the best example for that is, according to Tony Dwyer, who's our chief strategist at Canaccord Genuity, is it all has to do with demand. So just as an example, in the month of April, the US Treasury issued $68 billion worth of bonds. So in other words, to fund the operations of the US government, they had to issue $68 billion in bonds. Now, we also know that around this time, people were receiving money for their COVID relief and their various programs that they have in the United States. We also know that the banks invested about $63 billion during that time into treasuries, into other safe investments, as consumers, you and I, put our money into the bank account. I mean, the banks have to invest it somewhere. And so on a very short-term basis, they may invest in treasuries. And so, you have $68 billion of money being printed. You have $63 billion going with the banks. Oh, and by the way, the Fed has been spending $80 billion a month to buy back bonds. So it doesn't take, much math to figure out that there were way less bonds being issued in the month of April than there were bonds being bought. and no different than any other business. If you have more buyers than you do sellers, you know which way pricing's going to go. And so until that gets back, I think, to normal, the 10-year U.S. Treasury is going to be quite constrained at the price that it's at now, which is about 1.6%, which again, still incredibly low, but definitely we could see it over the next few years increasing higher and higher. And as these rates, as the rates go higher and higher, that's more of a concern to consumers, governments, and corporations who have a lot of debt. And if interest rates are higher, how do you pay that debt or pay the interest on that debt? It's going to be very, very difficult. So that's pretty well all I wanted to touch base on this month. Like I said, like I said last month, we're going to start reaching out as part of our regular review process to get a sense as to where everybody's gains and losses are and incomes were for this 2020 tax year, just so that we could do the appropriate amount of planning as we get into the end of 2021. And I know it's a long way away yet. We still really haven't had our summer yet. And speaking of which, summer, probably won't do one of these in July unless there's something in the market that dictates that we should. My view right now is that everything will continue bumping along as it is for the next few months. Again, anything unexpected can happen, but I would say that we're probably into a little bit of a bumpy summer, but no big issues happening out there. If there is anyone that you want to forward these videos to or link them to our website, feel free. More than happy to have this out into the marketplace. And definitely, if you have any questions, please do reach out to Jim or myself or Hengi or Angela. All more than happy to answer any questions that you have. And if I don't talk to you before summer kind of kicks off here officially, hope everyone has a great summer and stays safe and healthy.